Welcome, investors and curious minds. Today, we're diving into a concept that often lurks unnoticed in the shadows of success stories. It's called survivorship bias, and it's more relevant to your investment decisions than you might think. Let's start with a quick definition. Survivorship bias occurs when we focus only on the winners, the success stories, and overlook those who didn't make it. It's like celebrating those who've climbed Mount Everest, but ignoring the many who never made it back down. In the financial world, this means we often hear about the investments that skyrocket, but not about those that crash and burn. Imagine you're at a high school reunion. You might think your old classmates are generally more successful than average because you're seeing the ones who turned up, thriving and eager to share their achievements. But what about those who didn't show up? Possibly because they feel they haven't made it. This is survivorship bias at play, and it skews your perception. Now, how does this apply to investing? Consider mutual funds. Financial magazines splash the top performers on their pages, but rarely discuss those that have dissolved or merged due to poor performance. By ignoring these, an investor might conclude that picking a winning fund seems pretty straightforward, which is far from reality. Let's do a quick exercise. Think of the last time you read about stock markets. Did the stories focus on stocks hitting record highs? Now, try to recall any mention of those that plummeted. Harder, isn't it? This selective memory, encouraged by media and reports, feeds into survivorship bias. This bias can lead you to make overly optimistic investment decisions. So, how can you avoid it? Always look for the full story. When evaluating stock performance, dig into historical data, not just the current champions. Look at the average performance of all stocks, including those that didn't survive. Here are 3 practical suggestions to help investors avoid falling into the trap of survivorship bias. 1. Diversify data sources. Avoid relying solely on popular investment reports or mainstream financial news, which tend to highlight successful outcomes more frequently than failures. Instead, seek out a variety of data sources, including industry reports, academic research, and independent financial analyses. 2. Question popular beliefs. Cultivate a contrarian mindset by critically examining prevailing market trends and popular investment choices. Ask why certain investments are favored and who could benefit from promoting those. 3. Expand beyond historical performance. Instead of basing decisions primarily on past returns, focus on understanding current market conditions, economic indicators, and sector trends. Remember that prices cannot grow forever. If an asset has recently demonstrated remarkable growth, it might already be out of steam. Those who open positions at the bottom benefit the most, and at some point, they will choose to sell. Make sure you are not the one who buys from them, right before the price crashes. As we wrap up, remember, survivorship bias isn't just a small error. It's a significant blind spot that can distort your investment strategy. So next time you hear about an unbeatable investment, ask yourself, what am I not seeing?